Yo, what's up everybody? Wednesday, August 11th. Hyperinflation! There's hyperinflation! Yeah, we got the CPI today. Core CPI rose a whopping 0.3%. Woo! So that was below forecasts. And I don't know about these inflationistas. Look, if you look at what's been happening over the past, 5 months or so, I mean, this just looks totally consistent with an economy that was rapidly emerging from a pandemic, and now things are starting to somewhat normalize. So you had a spike up in prices. I mean, I was talking about this back in March, with the lumber and commodity prices and everything else, and all this hysteria about hyperinflation and the big short guy, Michael Burry, and he was, all this stuff. And everything that is going on now is really consistent with what the reality of the situation was, which was the economy was coming out of the pandemic. It was opening up. There was a lot of pent-up demand. You saw prices spike up a little bit, and now things are starting to moderate. So again, this inflation hysteria, I think, the reality is, the truth is, the numbers are starting to bear this out, that things are starting to get back to a more of a normal situation. Before I go any further, let me just mention that I put up a new podcast today, and the link is right here in the description below, so don't forget to check out my podcast. I think it's a good one. I think you're going to like it. All right? Other news. So we had a rally in the bonds. Yields came down a little bit. Stocks, I'm telling you, looking good. Looking good because the fiscal flows are still, as a matter of fact, they're not just strong, they're starting to pick up again. I think I said that in my last video, that there's evidence now that I am seeing where there's like a gradual reacceleration in the fiscal flows, and that's good. All right, we got the infrastructure deal, which that still has a ways to go because the House has to vote on that, and there could be some resistance there because the progressive Democrats in the House, they want more stuff included in there on like climate change and their agenda, that stuff. So I don't know how that's going to go. Anyway, the House reconvenes. I think they come back from vacation August 23rd. And then the Senate is out, I believe, till like September 9th or September 11th. So, the final deal is still a ways out there. We still have the debt ceiling where Senate Republicans, they're going scorched earth on this. They say, hey, look, the Democrats can do this on their own through reconciliation. That's what they're saying. I don't know if the Democrats can pull off reconciliation because you got Senate Democrats like Joe Manchin and Kristen Sinema of Arizona. They're against the $3.5 trillion. So I don't know. It's going to go down to the wire. I can tell you this. Okay, we're under the debt ceiling right now. The TGA, that's the Treasury General Account, that's the Treasury's account at the Fed, is down now to $416 billion. All right, remember, we were all the way up at 1.8 trillion like last July, like a year ago. All right, we're down to 416 billion, and that thing is going to go down further because Treasury has to spend out of that account. All right, and if you go back and you look at the last time we were under the debt ceiling when Mnuchin was Treasury Secretary, that thing got down to like 111 billion. So, there's like 300 billion more, and who knows, that thing could go down to zero if they don't raise the debt ceiling. So it's going to get very, very interesting. But the reason I'm mentioning the TGA is because just in the last week, from like last Wednesday to today, that thing is down by 100 billion. So what does that mean? It means a significant amount of new reserves piling into the banking system. As a matter of fact, I don't know if you saw this, the Fed did a record 1 trillion of reverse repos today. So the Fed has had to, really ratchet the reverse repos up to sweep all that cash to give the bank some breathing room. But I think we're going to see still, in spite of that, another record high in reserve balances when we see the numbers tomorrow with that weekly release, which means, we're running at record reserves. I mean, there's no way that bond yields are going to stay up with reserves just piling up in the banking system to the tune where the Fed's now doing $1 trillion a day just to keep that thing from really blowing through the roof. I mean, all that cash in the banking system is just going to pull yields back down. And I said this once before, even if the Fed said tomorrow it was going to raise rates, unless it reduced its balance sheet at the same time, I doubt even a rate increase would hold on for very long. You'd see rates start to come right back down again because there's just too much cash floating around in the financial system. And it's interesting because this run up in bond yields that we just saw over the last week, right? I mean, those are people going short the Treasury market, I think, and it's going to probably be borne out in the numbers when I check the numbers. But those are bond market shorts, okay, or really weak longs who are liquidating. And I mean, today these numbers that we saw on the CPI, I mean, 0.3 core CPI increase, that's pretty much in line historically with numbers we've seen. That has to be a disappointment for these people. And they're short the market. And you got trillions, you got all these reserves piling into the banking system. I mean, this is going to play out to be a very, very interesting thing. And I still think that yields are going to come down, and they're going to come down significantly. Significantly. And that's not even to mention, I mean, if we get this infrastructure deal, and you see the deficit drive up to, what is it now, 2.5 trillion, and the deficit goes to 3.54 trillion. I mean, there's no way that we don't see negative yields. I mean, I just gotta be. I mean, that's just too much cash floating around. And again, I just say, there is no reason in the universe that the United States, look, Warren Buffett, his company, Berkshire Hathaway, borrows a 30-year at 0.5%, and the U.S. Treasury 30-year is 3 times higher than that. This is nonsense. It's ridiculousness. There's infinite more risk that Berkshire Hathaway has, if you're a creditor. Just like what I was talking about, Italy, Greece, Spain, Portugal. Their rates, even Germany, France, it doesn't matter. Their rates are much lower, and they have those bonds have infinite more risk than the United States. None of those countries are currency issuers, and they rely on the ECB. And basically, the ECB has become like the de facto fiscal authority for the Eurozone. I talk more about this stuff in my podcast today, so you probably want to check it out. So it's all green for the stock market. I mean, when you look at conditions right now, and again, for me, the core thing that I look at, how's economic activity going to look? It's very simple. When you have this level of net transfers, when the government is net spending all this money, that's going to flow to corporate profits. That's going to flow to personal income. And I mean, it's again getting back to this this example I've used of the pump, the fiscal pump, filling up that pool with water. I mean, until that pump goes in reverse and starts sucking out, then I mean, the level is just going to rise. You think of the stock market or you think of the economy as that swimming pool. I mean, it's just gonna continue to rise. I mean, that spending flows to corporate profits, and you could talk about, oh, I'm buying the market top or this and that as much as you want, but you know, it's like physics. It's like a force pushing against an object, and as long as that force is in place, you know, it's going to continue to push that object. And when the force is removed, yeah, then you could talk about, hey, we're going to go back down or something like that. Anyway, that's the update for today. Don't forget, go to my website, pitbulleconomics.com, sign up for a 30-day free trial of MMT Trader, and check out my podcast. See you tomorrow. Bye.